You can actually use your cash value life insurance policy to pay off your mortgage 5 to 15 years earlier, which most people have no idea about. Most people do not know what this strategy is. Most people have never heard of this strategy, but a lot of people, the ones who do, they use it and they benefit from it tremendously. So listen up and I will show you, if you have a mortgage, if you're about to buy a home, if you already have a home, whatever the case may be, multiple homes, I'm going to show you how you can actually use your life insurance policy to pay off those properties a lot sooner than the 30 years out. My name is D.L.Morgan. I'm the CEO of the Family Insurance, and welcome to another episode of Black Money. Now, this month, as I said in the last episode, if you did not see it, welcome. If this is the first episode for you, welcome. September is Life Insurance Awareness Month. And in my last episode, I went over a few different uses, a few different details, small little things that you can do with the life insurance policy that many of you were not aware of. And I don't know if you remember, but I had mentioned that you can actually use your cash value life insurance policy to pay off your mortgage 5 to 15 years earlier, which most people have no idea about. Most people do not know what this strategy is. Most people have never heard of this strategy, but a lot of people, the ones who do, they use it and they benefit from it tremendously. So listen up and I will show you, if you have a mortgage, if you're about to buy a home, if you already have a home, whatever the case may be, multiple homes, I'm going to show you how you can actually use your life insurance policy to pay off those properties a lot sooner than the 30 years. Now, we all know how mortgages work, right? We all know how mortgage home loans work. Go to the bank, they approve you for a 30-year mortgage, 30-year note, whatever that case may be for $1 million home, $300,000 house, whatever the case may be, right? Now, what a lot of people do is they want to pay off that mortgage a lot sooner. So what they'll do is they'll put that money, they'll take excess funds that they have allocated for the mortgage, and they will pay extra every single month to the bank on top of what they already have to pay through the note, right? Now, this is one option, right? And you can do this. It's not the best option for you, but you can do this, right? It'll go towards the principal, and the bank will lend your money out 18 times through fractional lending, and then someone else, and they'll get rich off of it, right? They'll benefit from it, right? Now, you can benefit the bank. If you care about the bank that much, go crazy, do your thing. You can pay the bank, right? They'll take your money all day. Now, if you are like me and you care about yourself and your family and your situation a little bit more, then you need to pay yourself and make yourself the bank. And that is where your life insurance policy comes in, right? So here in this example, we have a 45-year-old female, right? And let's say she just bought a $400,000 home, $500,000 home, whatever the case may be. Let's say she has an extra $300 that she can spend every single month and put towards that mortgage. Now, again, she can put that $300 towards the principal and give that money to the bank and let them spend it and get rich, or she can put it into her cash value life insurance policy where it will benefit her and her family a lot more. And let me explain. So this will do two things. So the first thing it'll do is it will give her a $180,000 life insurance death benefit, where if anything were to happen to her in the interim, while she's paying off her mortgage, while she's going about her day-to-day, everyday life, it will give her family $180,000 that they can use for whatever it is that they need, whether it's the mortgage or something else, right? Now, let's say, like I said, she got this policy at 45. Let's say she held this policy for 20 years, right? Year 20, she would be 65. Right? This one says 64 because it counts 45 as the first age. So we'll say 20 years, she'll be 65, right? In that time frame, she would have put in a total of $72,000 into the policy. 3,600 times 20, $72,000, right? But her cash value, look at this. This is where the meat and potatoes is. $114,762 that she now has access to, in which she can use however she wants to, whenever she wants to. That's almost $50,000 more than what she put into the policy. Now, where would you get these type of returns putting $300 away anywhere else? It's very rare to find. Not only that, she's guaranteed to never lose any of this money. This money is protected and guaranteed to be hers. This will not change. So if the market crashes tomorrow and she has this in her account, tomorrow she will still have this same amount in her account. Not only that, as you can see here as well, if she decides to keep the policy, her death benefit then starts to increase as well. So if she never cashed it out, if she never took any of this money out, her cash value would just accumulate. And she does not have to take all of this money, right? The $114,000. She doesn't have to take all of it. She can take some of it and leave a little bit. Let's say she takes $100,000 out because she wants to save a fifth or of what she would be paying on her mortgage and just pay $100,000 off of it, right? She would still be making the full interest rate on the full $114,762, even though she took out $100,000, right? She wouldn't just make interest on the difference between 114 and 100,000. She would make the full interest rate on the full 114,000, and she would never have to pay it back, right? Because this is her money. This money essentially becomes a loan, right? And she can pay it back if she wants to, right? She can make herself the bank where she's she holds the lien, right? And she pays herself back. Or if she does not want to do that, she can cash out and use that money for whatever she needs and let the policy just cancel itself out, right? Now, that is a great example in which you can use your life insurance policy to pay off your mortgage that much sooner. Because by year 20, if she has a $400,000 mortgage, by year 20, there may only be $100,000 or $200,000 left, $150 left, and she dumps all of that money towards it. She's getting a huge discount on it because she does not have to pay that money back. So she only spent $72,000 to make $114,000, and she can use that full $114,000 to pay off her mortgage that much sooner. This strategy right here, it's insane. A lot of real estate investors, a lot of these millionaires, billionaires use this strategy, and we can use it too, right? It's all about having the knowledge and the know-how and the wherewithal, all three of which we have. I can show you how to do it if you're buying a home, if you just bought a home, if you have a mortgage. I can show you how to do this regardless of the situation. If you're interested, let's talk about it. Until next time, and happy Life Insurance Awareness Month.